morning, ladies and gentlemen. What a privilege to be with you all again for Boutiques on Wednesdays, and thank you all for joining us. For the calendar year 2024, investors were spoiled in fixed income funds, with some of these funds giving investors as much as inflation +7. But the past 3 months were very bumpy indeed, with global uncertainty increasing and bond yields on the rise. Does higher rates for longer translate into benefits for clients invested in fixed income funds? So what is the glass half full argument? And how much bad news or good news are already priced into SA bonds and the fixed income landscape, especially given our delicate political landscape? What can and do we expect from fixed income funds for the rest of 2025? With that, it's my absolute pleasure to welcome two of the top fixed income managers in South Africa this morning. First, a gentleman who needs very little introduction, Jonathan Meyerson, Head of Fixed Income and Multi-Asset Strategies at Visio, and newcomer to the BCI audience and boutiques on Wednesdays, Chief Investment Officer at Thyme Wealth, Helen Mason. Helen might be new to some of us, but Thyme Wealth has a phenomenal track record in managing a fixed income fund and other fixed income mandates. Good morning, Jonathan. Good morning, Helen. Thank you so much for your time this morning. How are you keeping?
Very well on this morning. Sun shining in Johannesburg.
Fantastic. No roads or rivers flooding the suburbs this morning. We'll see how the weather holds. Helen, you can start to share your screen if you're ready. Jonathan will follow Helen after a presentation. To our audience, by now you know how it works. Please post your questions in the Q&A bubble, and we'll cover as most of that as we can after both presentations. Helen, I can see a presentation coming through. Presentation mode. And yeah. I think just hit that presentation screen button again. Let's see what happens. There we go. Perfect. Helen, thank you so much again for your time, and we're ready for you.
Okay, so I want to say good morning to everybody. Yes, today is a big day, a day of tariffs and taxes. But if I can say early in my presentation, we always say that in every threat, there's an opportunity. Thank you, BCI, for having us on your platform. It's a privilege, yes. Today, if I can focus only on 3 topics, I know I've got a very short span, only 15 minutes, but I would really like to start off by focusing on what clients' needs really require. So first of all, focusing then on your needs. But then I want to take you down memory lane, and I want to take you back to March 2015, 10 years ago. But most importantly, in terms of investment decisions, I want to challenge your logic. Let me see, how do I do the next slide? Sorry. Okay, here you can see. I'm going to deal with my first 2 topics on the left-hand side. I think we must realize people hate losing money. So if I start there and I say that clients really don't want to lose money, but also they don't want to overpay for fees in terms of fees. And they do expect their manager to do really their jobs very well. And so the outcome longer term is reasonable investment returns, but also consistency. I want to sleep well. I don't want to be a black and red on the board, you know, very rich or have nothing. So consistency of returns makes investors sleep well. So to us, when we look at clients, that is basically what we try to achieve. Don't lose my money, be fair in my fees, and really try our best for the best performance on a consistency basis. So what I need to focus on in terms of taking you down memory lane, I've got this performance numbers of the different asset classes, but I really want to focus your attention to the 1 year and 10-year returns. We always say that we've got a wisdom that property will always, shares will always outperform bonds, and especially in politically unstable climate, like you started off, Eugene, and you said, you know, it's tough times. But if you look at March 2015, 10 years ago, we were sitting at 11.5 in terms of the rand, and Netgate was waiting just around the corner in December 2015. At which stage the rand went to 19 to the dollar. So a very unstable political era. It was the era of state capture. 2015, for most of the last few years in that decade. And yes, yeah, high uncertainty. You know, it sounds so similar in South Africa. We're getting used to it, but similar to the conditions that we're currently experiencing. And during that period, and let me leave out foreign equity, but if you look at it, you could clearly see that SA bonds effectively was your best local asset class over the 10-year period. And so if we look at learning from the past, yeah, be careful to run away when you're feeling scared. You have to look through and see whether there's value and whether the bad news is already discounted. If you look at what Eugene said, in the market, yields have been moving up, and so how much of the bad news is already discounted then in the price? If I look at the 1 year return, of course, we had the government of national unity, we were optimistic, and we saw all our asset classes actually performing very well, close to the 20% mark. And so it was a wonderful year in terms of investments. And so if we can get it right, South Africa is so underpriced in terms of all our asset classes that there's a massive opportunity in South Africa if we do get it right. And so, yes, we're talking about inflation plus a margin in terms of what we're targeting, whether it's 3 or 5, 7%. But effectively, there is blue sky if we do get it right. So that's my taking you down memory lane and putting it in numbers that we don't lose perspective. If we then look in terms of the left-hand side on this slide, you can actually see if we start off with long-term inflation. Now we know that the midpoint looking forward in terms of inflation, the Reserve Bank gives us guidance around 4.5. Now, if you look at the previous slide, we effectively, over this 10-year period, we had a performance of an inflation rate of around 6%. So we definitely looking at an improved inflation outlook, okay, also because of lower growth globally, but of 4.5%. So if we add the real rate that we would require 3 to 5% in order to live, because remember, typically you will have your liabilities in rand and your living expenses in rand, and you need to outperform in terms of rand with a rate of around 3 to 5%, and say an overall cost of a 1%, you're looking at a targeted return of 8.5 to 10.5 in order to meet your liabilities. And because we say don't lose my money, we're focusing today on the income fund, which in terms of the risk is one of the lowest risk products available. If you look at then in terms of how does the income products, and I use our numbers as a proxy, how does income funds compared to this required return of between 8.5% and 10.5%. So if you look at the orange line, that's inflation plus 3. Clearly, we've done much better than that. If you look at the green line, is the Thyme multi-asset income fund. If you look at a return of inflation plus 5, the income fund, and this is going back effectively to show you over time, has actually also beaten inflation plus 5. In markets that felt just like today, very uncertain, the political outcome uncertain. So, and I'm going to, when I go through the testing your logic, I'm going to say to you what's the 2 requirements that is necessary to stay for us to be positive that the income space will allow that. If you look at it, I've got to use something about our Raging Bull Award. This fund has won the Raging Bull Award in 2023. And if I look at the latest Morningstar numbers for end of February, the fund is 7 years old and we ranked first over 7 years. So thank you for allowing me to say that as well. So we, however, launched this product also in 2012 at our previous firm. That's where it started. And so this is not a sparrow that we're bragging with. It's our 3rd Raging Bull Award that we've won for best risk-adjusted performance over 5 years since 2012 in a similar product over 2 companies. So what's the secret to us in terms of consistency? If you look at consistency, from day one, we designed this product to have a SA-only exposure. And we now know that ASISA is going to launch the category SA-only exposure, so we will fit in perfectly in that category. But we also have an exceptionally low duration limit of 2 years, which makes it virtually or closer to a cash portfolio than a bond portfolio. And that is to achieve the consistency in the returns that we believe clients could sleep well if they do have that in their portfolio. So why did we say a rand exposure? You know, if I look at the logic, I said, I'm going to challenge your logic. South Africa is actually very well positioned in a global economy. Sea routes and is becoming more and more important. And there you can clearly see that the Cape of Storms, yes, a tough route, it's far, but at least you can get your goods to the other side. But more importantly, one of the requirements that I'll talk to you about later as well is that you do need a credible reserve bank. You need an open economy where global influences is direct into your economy. So if you don't stay in line, then effectively there is a punishment linked to that. But you also need then a reserve bank that will act in time. And the reason why the Reserve Bank acts in time is because their mandate is looking at price stability. So they have to manage the inflation rate. That's their job. And so that's one of the key factors in terms of why a SA-only portfolio will react very well. And yes, like I said, you need income, rand income for rand expenses. So when we designed the product, to us, it was actually logical that we should have 100% rand exposure. If we look at the evidence, now what we've done here is to show you the fund return, which is the green line, and you can see the consistency in terms of return. But we measure it in terms of a low conservative portfolio in dollars that has the rand exposure then built into it. And there you can see the return on a similar product in the US, which is conservative. So we measured in terms of that. And you can clearly see how volatile the return of such a portfolio would have been over the full period if you measured against a South African only portfolio with a low risk parameters, Rand only 2-year duration limit. And so, yes, not only is it consistent, but it's also outperforming. If I then can say, in terms of the requirements for meeting this, I said to you, the Reserve Bank needs to be credible, but you also need deep, well-developed markets. So open economy, deep developed markets, that's the second requirement. And you need to diversify your portfolio. So if you look at the opportunities in South Africa to diversify your portfolio, you have from the repo rate, variable rate instruments, inflation-linked bonds, you do have nominal bonds. And in actively managing those different or diversification, different bonds and exposures, you can manage both capital and interest actively in a well-developed market. Now, we as a fund do have exposure to credit, but we keep it limited in the portfolio because we need the flexibility to move between the different bond classes in order to manage the risk in the portfolio as well. So the two requirements that you need is a credible South African Reserve Bank. If that goes, then we'll have to rethink it seriously. But secondly, you need a deep, well-developed bond market and an open economy that allows for diversification and active management. And so if you look then at, if I can say, just introduce ourselves. As you don't know us from previous presentations, Thyme Wolf is a family-owned business, started in 2018, and effectively, we believe in good governance. We also subscribe to the CF Code of Conduct, and our values is not negotiable: honesty, integrity, respect, commitment. We learned the hard way how important these values are in the past, so to us, it's very important that we actually put that on the table. Myself, got a MCOM in econometrics. I've been at Eskom Pension Fund for a decade as the CIO, but I've also got merchant banking and treasury experience in my lifetime. Yes. So if I can just say one thing, what makes Thyme unique is our strong values. I think our commitment to clients and understanding clients' needs, our commitment to excellence, and the insight and knowledge which we are always willing to share. So please look at Thyme too. Thank you.
Kevin, thank you very much. If you can unshare, then Jonathan can start sharing his presentation. We'll take questions. There's a couple of questions coming in already. We'll take some of the questions after Jonathan. Jonathan, you should be able to share from your side.
Let me just see how I unshare.
That, I think it's off already.
Okay, is it off? Okay, wonderful.
Yeah.
I'm almost there.
Yeah, you can see a presentation coming through.
Okay, just I've been on the wrong screen. I'll be looking at the wrong. Okay, let me try that. Yeah. Okay, thanks. Thank you very much. Good morning, everyone. Can you guys hear me?
Yeah, Jonathan, perfect. Yeah, everything is good.
Okay, great.
Thanks.
Yeah, thanks very much. Thanks, Helen, for a very interesting presentation. I'll follow on in some ways, you know, also taking you through a bit of a kind of the history of the multi-asset income category over the last few years. But I want to focus on the importance of flexibility and diversification in these types of funds. The market has changed and does evolve over the years. And, you know, certainly what we're seeing in 2025 always has some similarities to the past, and it's important to remember those. But the market has evolved quite a bit, and we kind of going to take through a bit of a journey of that, how that's kind of happened and how we go about it. So the fund that we will focus on is the Visio BCI Unconstrained Fixed Income Fixed Interest Fund, which we've been managing for quite well since 2012 and since 2016 as a unit trust. So just to kind of take you back to the environment we're in, or the kind of where the income funds really fit. This is essentially a risk return kind of chart, which shows you that you can start with the money market, which is, like Ellen said, it's very low risk and provides you with very kind of stable returns. But as you go up in the risk spectrum, you get more return with a bit more volatility. Now, one of the things I need to point out outright is the difference between volatility and risk. When we talk about volatility, as we talk about market levels moving up and down, we talk about risk, we talk about the risk to the capital. So, and then I'm really kind of starting to talk about the risk of having a government bond versus a corporate or a bank bond. So that's something to keep in mind. So essentially, we're in the income category. We want to return to the clients, you know, somewhere like historically it's been 8.7% over the last 24 years on an annual basis. And we looked at a way of actually providing that type of volatility, okay, which is relatively low, but with a higher level of return by having the flexibility to move around the sub-asset classes. So at times we can have nominal bonds, at times we can have money market, ultimately to get a return which is more similar to kind of nominal bonds. That is our secondary goal, because ultimately our first goal is to achieve that benchmark objective, which in this case is a STEFI times 1.25. So the idea is to move around and to essentially find the best point. And Helen showed a nice chart initially to show how the different asset classes perform differently over different parts of, you know, of the cycle, really. So how we do it. Now, historically, again, going backwards, if you just take 20 years back, most of the income fund investments were in non-government bonds, either short-dated government bonds or corporate and bank bonds. And I'll talk to the reasons for that just now, and I'll speak to how that kind of is evolving. Now, a plug for the Reserve Bank. Helen mentioned how important they are. Last week, I attended a conference where the Reserve Bank essentially celebrated 25 years of inflation targeting, and walking away from the conference and having known the Reserve Bank, how it acts, and how there's one source of very much light in the South African economy is the Reserve Bank and the job that it does. And it's done a very, very good job, and I think we all need to recognize it. But what has 25 years of inflation targeting meant for inflation and for multi-asset income funds? So first of all, just kind of, you know, most of you will remember early 2000s, inflation was high and very, very volatile. In fact, if you went further back, it was even higher. And with inflation targeting, which was, you know, it's changed a little bit in terms of the ranges and so on, but ultimately, most of the time, it's been targeting between 6 and 3%. As I said, with, you know, time, it actually went down to 2 to 3 at one point, and now you could consider it as being 4.5%. That's basically what the Reserve Bank has kind of fixed or been focused on over the last few years. So a nice downward trajectory of inflation. And over the decades, you can see, you know, between 2000 and 2005, inflation averaged somewhere around, it's on the right-hand side, somewhere around 7%, and it's been trending lower. 2020 to 2025, you can see quite a lot of volatility, but I think a lot of that has to do with COVID, and ultimately, you know, in more normal conditions, if there's ever such a thing, you'd find inflation would have averaged a lower rate than we've had over the last 5 years. And now, of course, there's a new range in discussion. I'm not going to go there. It's quite a hot topic right now. I think that's why the Reserve Bank also had its conference now, basically for bringing a lot of academics and practitioners to discuss whether it's feasible and will be beneficial to move inflation target from, implicitly being 4.5% to explicitly moving it down to 3%, and with all the cost benefits that comes with that. But ultimately, what it meant for income funds, this is the multi-asset category, income category, on a real return basis. I'm just taking about 12 years backwards. If you went further back, the line pretty much remains the same. But look at the, first of all, you got real return. This is for the category of about 2% on average for the full period, per year, obviously. And then that kind of trend has been moving upwards. So as the Reserve Bank has been getting more credibility, more able to lower the inflation target and stick and meet that target, so as multi-asset income category investors have benefited. And yeah, to Eugene's point, last year was particularly good. I certainly don't think 2025 is going to be as good, but I certainly think that it's going to be better than the long-term average and still provide clients with quite an attractive opportunity in this asset class. Now, the next slide and the next section speaks to what I'd like to, there's a bit of a play on words here. There's no free lunch, but it doesn't mean that you should overpay. So really what I'm going to talk to, and of course the free lunch story comes from diversification. There's a well-known Nobel Prize in economic winner that said that the only free lunch in economics is diversification. And even to that, there are limits. And what I'm going to talk about is the limits of benefits of diversification when you're taking on risk. Okay, so it's not, and basically I'm going to be talking about the diminishing benefits of credit and corporate bonds in South Africa over the years as a tool to achieve your desired return. So just very briefly, income generating assets, which are the ones that you'd find in an income fund, and the focus is on the floating rate bonds. And you know that floating rate bonds essentially give you a kind of nice, smooth, upward line of returns, as opposed to fixed rate bonds, which are much more volatile. They give you a better return, but they're more volatile. So, what we want to achieve is we want to achieve this. But now the question is, what is the cost? And historically, floating rate notes, as I mentioned earlier, were what we call corporate or credit bonds. So non-government, which included banks, corporates, in some cases municipalities, and the like. So how's the market evolved over the last 20 years? Really, is that credit, those bonds that you need in order to achieve that very kind of smooth line upwards, as a percentage of the total amount of bonds in the market between 2000 and 2010 did increase because government was actually borrowing less, corporates were borrowing more, there was plenty of these credit bonds available, and investors were able to buy them for the income funds. But what's been happening over the last 10 years or so is that you can see here there is less and less of the total makeup of the market comes from the credit, and you can see that supply of credit of these bonds that you want for these type of funds has actually kind of been increasing in a relatively low pace versus demand, and that demand comes from the growth in the multi-asset income category, because as Helen said also, it's an attractive category. It fills in a lot of your requirements as a investor, and so what you see here is a classic kind of increase in demand versus supply, which what it means that prices are going to go up. And when we talk about prices of floating rate bonds going up, it means that the spread that you're getting over the rate that you need is declining. And this basically comes in this chart here. So over the last 15 years, if you bought a bank bond at a yield of, you were getting 175 basis points above your benchmark, now you're getting 105. So that already tells you that it's not available in the same kind of abundance and generous return that you were getting previously. Now, what's particularly important is that in 2010, you were getting your benchmark plus 175 basis points from a senior bank bond, but government was only paying you 20 basis points above that. Over time, what's happened is that as there's been more supply of government bonds, floating rate, I must tell you, so there's no difference in that kind of volatility that I showed earlier, but you're getting a better yield on a government bond versus a bank bond. So what we're saying is that be careful of just buying credit and corporate bonds because they offer you this diversification, because you can actually get it from a better quality, and government ultimately is still, despite all the issues, is still the best quality issuer of a rand bond in the country. So I think that's something that you need to keep in mind. Just the last point, and kind of also on this, plugging a little bit for the Reserve Bank, is what's happened over the last 25 years, really, since inflation targeting is introduced, is what I'm showing you as the yield curve. So basically in 2000, on the short end of the curve, 1 year yields were 11%, longer term yields were like somewhere around 13%. With both, initially, at least in the first kind of 10 years of post-2020, inflation was coming down, as was government debt. And that essentially allowed for yields to come down, which is obviously what the economy needs. Where we are now is we've got a steep yield curve, and we need to start looking and deciding whether it's worth, in these type of funds, taking on a little bit longer dated debt because they're giving you this high yield compared to the short end of the curve. Now, last point, and again, a plug for fixed income, multi-asset income funds, is that there's more to fixed income than just income. And really, very simply, what I show here is the total return, annualized total return for the different benchmarks. Those are the dark blue. The light blue are the benchmarks. So it could be like the Steffi, the Swix, and so on. And the dark blue are the categories of a CISA. And you can see that the multi-asset income category, and I'm not showing you volatility here, because once you put volatility, it's even more compelling to have multi-asset income as an important part of your investment strategy, because at first it gives you low volatility, but also it gives you these extremely attractive returns. And obviously, and I'll do a plug for our fixed income unconstrained fund, which has done materially better than the category. So essentially, I would be saying you should consider income as in a South African asset component as a big portion of your balanced fund, because it gives you these attractive returns, both in nominal and real returns. I'll leave it at that. I'm hoping that there'll be some questions, and we covered essentially what we were looking to cover.
Jonathan, thank you very much, and Helen as well. A couple of questions coming in from the audience. But I maybe want to start with the elephant in the room. I mean, 3 months ago, we all talked about, potential credit upgrades for SA, maybe towards the end of 2025. Moving 3 months on, if we look at what's happening now, not even to talk about the politics and the ongoing battle on the budget and possible rift within the GNU. But the big issue is our debt to GDP with no growth. The DI obviously fighting for more growth to be included in the budget. We're yet to see where that growth is going to come from. But given the current stance, Jonathan, the talk in the street at the moment is, or people are asking, what's the chances of SA defaulting on debt?
Yeah, thank you, Gene. It's a great way of putting it, because it wasn't so long ago that we were talking about upgrades, which I thought was extremely unlikely. So I think default is very unlikely in the kind of horizon that we look at 3 to 5 years. I think it's very unlikely. I think even with the difficulties around the budget and the fact that I think debt to GDP could continue rising and not consolidating where National Treasury thinks it will, I think it requires quite a lot of further deterioration in order to get there. And, but having said that, and the market, it's all about what the market's pricing in and, whether you're getting value for that. And to me, what's happened in the yield curve, and you know that it's steepened quite materially over the last probably 6 weeks, although it's been, and I showed in that graph. And that's essentially saying there is a risk here that things are not going well. But a default in Rand is so two things. When we talk about the bigger concern would be if South Africa defaults on a foreign currency, because ultimately that's where we can't print, in inverted commas, the currency to get our way out of it. The good news there is South Africa's actually got very low foreign debt as a percentage of local GDP. So let's say difficult times right now. I think National Treasury, past this hump, will be able to get us back onto track. And I don't think an upgrade by any means, but downgrade, but default is so far away that it's not in my, it's a 10% probability in my kind of spectrum of scenarios.
I mean, if we were to default, bonds are probably the last thing you need to worry about. Other things to worry about, isn't it? Helen, sorry, you wanted to add to that.
No, I wanted to go down your path. The one thing that government can do is they can tax us to death. So we'll all be dead before the government actually defaults. So beware companies and individuals, they'll come for us first, because we're the source of income that needs to fund the debt. Unfortunately, us and our children.
They have a lot more levers to pull indeed than what we do on the ground or corporates does. Jonathan, just very quickly, you also mentioned SA credit, not a very attractive space at the moment, paying lower yields than govies at the moment. Beginning last year, we all spoke more towards or favored fixed rate notes locking in high yields and potential for capital gains. Where are you at the moment? Are you leaning more to the floating rate note side, away from fixed rate notes, and will you ever move back into more fixed rate notes, and what will that catalyst be? Jeez, I think there's 4 questions in that.
So so you're right. We have been reducing materially the exposure to, I suppose we had a great opportunity, certainly in hindsight, post the elections, where we got all those capital gains, because a lot of that risk premium that was embedded in the yields was essentially, came out, and now some of that's coming back again. And I mean, we'll certainly look again, and we look every day whether we think there's value in these long dated bonds. At this point, it doesn't make sense to go too much into those, although they're starting to look more interesting, is because we actually are able to get shorter dated floating rate government bonds at a yield that essentially meets our kind of objective. If you get, call it JIBAR plus 1.5% on government bonds, that means you're getting a real return of close to 5% on a floating rate bond. So we like that, but we don't like that at the expense of the risk associated with certain banks or corporates. Not that they're not good quality, there are some of them that are not as good quality as others, but it's just become too narrow. And there are ways of getting good quality, low risk kind of exposure, without going fixed rate at this point. So we're still able to, because we've got that, we didn't talk about inflation in bonds. They were looking good for a while. Short end still looking okay. But so there are different places to find that return that you're looking for.
Helen, it also speaks to one of the questions from the audience. If you could maybe elaborate or touch on or continue with what Johnny said, looking at your fund, explain some of the components of the multi-assets used in your fund, and what has changed lately, or in so many words, what does your fund look like at the moment?
Yes, if I can say in terms of Jonathan's comment, is that if we look at our portfolio, we believe you're not rewarded for taking on credit risk. So if you look at our portfolio, it's got a AAA rating at this stage. And so that effectively means we've got a very high exposure to government bonds or instruments within the portfolio. We, of course, like the variable space. When they started issuing the variable floating rate notes, it was like, I think, more than 150 basis points above the curve. And so to us, that was a wonderful opportunity. And like Jonathan explained, if that spread narrows, then of course you also make a capital gain. And that is now closer to 100. So effectively, you've got a running yield, which is great. Our portfolio got a running yield of above 9%, 9.5%. So if we look at the next year, being in government bonds, being on the low end in terms of the risk curve, in terms of duration, and we do have this pickup, in terms of the running yield. So I think income funds will do well over the next year. Of course, you can't, after a 20% return in markets, whether it's in the equity or bond market, expect another bumpy year. That you need fundamental change to create that. But effectively, we still see that South Africa is actively, very attractively valued, all our asset classes, and that if you look at real yield, which is a comparison internationally after inflation, we rank the second highest real yield in the world. So we definitely do see value in even the longer end of the curve, especially coming up. So, and I'll tell you why we do see that, is there's movement in the grey listing, and whether we'll see some movement in the next year, improvement in terms of that we're getting off, or getting indications that we will get off the grey listing. That would be great. But of course, Trump is also doing a lot of work for us by his tariff policies. And so we definitely of the camp that the world is going into a lower growth phase. In terms of that, we do see inflation globally also softening, which means that the real yield will actually improve in the globe, but then also in South Africa. Remember, we're a price taker. Yes, so as long as we don't act silly, that effectively real yields will give us a very, very attractive opportunity in the next year.
Helen, I want to continue with that conversation. Also, one of the questions from the audience, and you touched on it, being removed from, or potentially being removed from the grey list. I mean, what impact, if that happens, what impact will it have on SA bonds?
It's the ease to do business. So, we in South Africa, we're looking at I saw some of the forecasts of the growth rate for South Africa even exceeds 2%. Now, let's call it 1.5 to 2% this year. Of course, any movement then in grey listing will make it easier to do business. And that is always good for growth, which is good for the South African economy.
Yeah. Looking at foreign investors into SA bond markets, I haven't got recent numbers. Jonathan, maybe you or Helen has.
Yeah.
End of last year, we had net positive flows, and for a couple of months, which we haven't seen for a decade or so. So foreigners buying into our SA bond market. Are those flows still positive? And do you think that the risks associated with SA are currently reflected in the yields? Or is there a chance that there can be more unknown risks that's not priced in yet, and we see our yields popping up again?
I think the political side, the government of national unity is actually quite important, because it did give the foreign, like you said, the foreign investors came back into our market. But if I look at 2025, and whether it's not only the bond market, but also the equity market, foreigners have sold us our assets, reducing the exposure to South Africa, and I think they will continue to do it till there's certainty. And of course, the whole development in the US also doesn't help us.
But I think exactly that. I mean, it's not necessarily a hands-off SA argument. It's the global uncertainty argument, hence people moving towards a risk of trade. Jonathan, just looking at your fund again, you mentioned at the February roadshows, and you also briefly touched on it, that you started increasing exposure to ILBs. Where are you on ILBs at the moment? Are you increasing or just holding?
So yeah, right. We've been increasing up till around, well, actually just after the budget, and it worked out well because in some ways, VAT increase means high inflation, and net, it's positive for bonds. So we looked at when the inflation cycle turns, for inflation bonds, they outperform. But we focus on the short end of the yield curve because there's relatively less volatility with that. We haven't been buying anymore because I think that end of the curve did actually reflect that and did perform well as a result. And it's all, it's about the dynamics, about relative value in nominal and inflation linkers. And to Helen's point, right now, again, those floating rate bonds are looking more attractive. So this fund will buy inflation bonds when the time is right, but usually shorter duration ones up to kind of 6 to 7 years. And the majority of our holding currently, which is about 7.5% of the fund, is in nothing longer than 5 years. Well, there's a bit, but basically most of that 7.5% is 5 years and shorter.
Yeah. Jonathan, maybe just quickly back to things like our rate cycle, SA inflation under control, looking good at the moment. We see energy prices coming down, whether that's because of Trump or not. I mean, we're not going to go into that debate, but there's definitely more room for SARB to cut rates. There's been argued by several economists that we should have cut a lot sooner, a lot harder, but we know the Reserve Bank is conservative, trying to, almost put a backstopper on our currency. But if we look at our currency as well, the behavior over the past month, and that almost shows me the resilience of the SA economy, and perhaps that a lot of bad news are priced in already. But given the current situation on our currency and inflation, do you think that SARB will become a little bit more aggressive on rate cuts?
So the Reserve Bank is not going to be more aggressive on rate cuts for a very long time because the governor is very adamant at getting inflation down, inflation target at 3%. So if he gets his way, and some say that in his back of his mind he's already targeting in the policy. So if he gets that, then that means that policy rates will be stickier for longer as he comes down towards that. So I think I agree that there is space for a rate cut. Inflation is surprised again last time on the downside, so that's certainly a reason to cut further. But the SARB is that conference was very telling, and if anyone's got time, they should actually go and watch some of the presentations. There was a very strong message. He's not going to get it from National Treasury though, because National Treasury's got other things to. Because National Treasury essentially gives him the mandate and tells him, what inflation target should be. So part of the whole mission now is to convince National Treasury. National Treasury is saying we've got other things to deal with right now. Lowering the inflation target now could actually make it, at least optically, debt to GDP could be even higher as a result, and we don't want that. So long story short, I think there's another rate cut coming, even with the hawkishness. But a cutting cycle resuming, going down to kind of, 100 basis points, I think it's going to, and also just to the point of the currency, what's priced in, what isn't. We have to remember, and even though it's sometimes just in South Africa still kind of sentimental or in the psychology, or the price of gold is at all-time high. Now, I know we don't, it's not as important as it was 30 years ago, but it's still important enough to support the rand. And if it wasn't for the gold price being, okay, everything else would have been different as well. If it wasn't these levels, I think the rand would have been under much more pressure than what it is now, which has generally been good, although today is not looking particularly pretty, but that's that's another story.
The rush for gold, we're not going to talk about that today, but the world's going crazy for gold. Maybe just quick, Helen, to understand your fund a little bit better. We know that in the mandate of SA Multi-Asset Flex Funds, there is an allowance for SA property. We know that everybody shied away from property over the past 5 years for all the wrong or right reasons. Is this something you would ever look at of including in your fund at the moment, going forward maybe?
We actually do diversify the fund, not only in terms of pure bonds. So if I look at one stage, we had pref shares in the portfolio, we have property, had property in the portfolio. So yes, we do actively use it as a multi-asset strategy.
Your property exposure at the moment?
Very little.
Very little to low. Right. I think I'm going to end it off there. We've covered a lot of questions that came in from the audience. I think the biggest concerns was around the risks associated with SA fixed income, where SA is at the moment. I think we, Jonathan, you and both Helen, covered that extensively. And I think, the key message is here, you're not oblivious to those risks. Those risks are managed within your fixed income mandates. So when things are a little bit more bumpy, leaning a bit more to floating rate notes that are less sensitive to all the noise in the system, and you'll obviously reposition as things improve, and depending what the outcome will be from the GNU and our budget, we're all waiting to see what that will be. I'm not going to hold my breath forever, but I'm going to end it off there. I just want to say thank you very much for this morning, both Jonathan and Helen. Helen, it was a very good introduction to Thyme Wealth Management. Like I mentioned in the introduction, your portfolios or your skill set's been around for a long time. So maybe new to us, but definitely not new to fixed income markets. Jonathan, you as well. I mean, your fund's been long-standing. A couple of accolades and industry awards as well. Thank you both for coming on the session this morning. There's 1 or 2 or 3 open questions that we will circulate to the both of you. If you want to comment on that, we can send it back to the audience. You're more than welcome. And to our audience out there, quick reminder, next week, Wednesday, we've got Bateleur Capital and Sasfin Asset Management, and we will continue our conversation on what to look for and what not. Ladies and gentlemen, to our audience, thank you so much. The BCI team doing a great job. Thanks a lot.